Well, these are largely incremental measures, and many of them are really focused on the immediate task of increasing confidence in the markets. But it's really the policies that we've seen are about having Chinese domestic money flow into the stock market more easily. In other words, what we haven't seen is really a significant shift in the overall environment here. And that environment is marked by two concerns. One is the escalating US-China trade dispute, and the other is the broader slowdown in China's economy for domestic reasons. So these are policies that show Beijing stepping up to support the markets, but I think there are questions about how sustainable this is, given that we haven't seen a wholesale shift in the overall environment right now.
You make it sound like it's turning around the Titanic. In terms of trying to navigate these icebergs of the slowing economy and the trade war. Right, Michael? Whatever they're doing right now to try and bolster confidence, these are like drops in the bucket.
That's right. These are largely incremental moves, and there are some good reasons for that. From Beijing's perspective, what they don't want to do is go down the old road of a massive stimulus fueled by the banking system that exacerbates China's financial risks.
Right.
They're not at that stage yet, and so they're trying to do as much as they can to boost confidence without increasing those financial risks. And that's why you're seeing relatively moderate measures to date.
So, Rob, why do you think China's a good place to be?
So, of course, the biggest concern today with China is the trade war with the United States. There's been a lot of rhetoric. I think look at the history, though. All of the rest of the world is come to the table and set up a new bargaining agreement. I believe China is going to do that as well. And once that information comes out, I believe the bottom will be in and will be on that. Will that occur in 1 month or 3 months? I'm not sure, but I think it's fairly soon. But the market is pricing in today a real slowdown in China that may not occur. They're still growing at 6.5%. The data that came out the last couple of months is still pretty good. 6.5% income growth on households. Retail sales are pretty strong. And if you look at the opportunities this sell-off has created, companies like AIA Group, which trades in Hong Kong, that's the largest insurance company, now trading well below its growth rate and a very high-quality company. Another one's Alibaba. So what will happen is people will come in and support these stocks because they're just too good growth stories to have them trade in the low, underneath their growth rates and really sell at these levels. So I think China is too big to ignore. Investors in the U.S. probably have far too little of their portfolios in China today, and the time to do it is when people are sweating. And they're sweating today, and they're worried about China.
They have been sweating in recent months for sure. Michael, Rob sounds relatively sanguine about an exit on the trade dispute that the U.S. and China are in. Do you share that view, or is China digging in for a long fight here?
Well, I think his point is right that you have to take a long-term view. That said, I'm a little bit more pessimistic about especially the outlook over the next year, especially with the U.S.-China dimension right now. Investors are looking ahead to the possibility that Trump and Xi meet at the G20 summit at the end of November. That is a really important opportunity to try to de-escalate. That said, right now, I just don't see the U.S. or Beijing really in a position to narrow the gap between the two sides. The Trump administration thinks they still have the leverage to hold out for a major deal. The Chinese economy is hurting, U.S. markets, U.S. economy is still going strong.
Right.
And then you have a broader political environment where both parties are favoring a get-tough approach towards China. So I think that there's a risk here that this really drags on into 2019 and that we see further escalation. So I'm pessimistic about the outlook on the trade front right now.
To Michael's point, Rob, Axios did have that report, I believe, on Sunday that President Trump wanted to see the impact. He wanted to wait longer to see the full impact of the tariffs on the Chinese economy because he believes that that would give him more leverage. If the G20 summit in Argentina comes and goes without any sort of overtures, any sort of progress, would you reevaluate your position? At some point, right? You're talking about 8% allocated to China in some of your most aggressive portfolios. It gets it gets to be a pretty painful trade.
I think what I look at is the fundamentals. Whenever I go to China and I study what's happening over there, I become very impressed with the middle class, the emerging middle class, and the income power that sector has. I think that's going to out. China needs us as much as we need them, and they both realize that. going to war on taxes on each other is not the way to do it. We will work this out. I am confident that China will blink and Trump will blink too, because we both need each other. So I'm very optimistic that's going to happen within several months.